Hello and welcome everybody. Happy Friday. It has been a fun week in the market and a fun week overall. I got to celebrate my 25th birthday yesterday, and I just wanted to say a special thank you to everyone that reached out. I received so many emails, Facebook messages from people wishing me a happy birthday, saying how much what we're doing here means to them. And to all of you, thank you so much. Thank you for being part of our family. Thank you for being in these webinars, for participating, but mostly for giving all of this purpose. It's nothing if all of this information we share and the tool itself is really not anything if it weren't for people like you all that engage with it and can benefit from it. Because as much as I would love to use the Matrix myself, knowing that it's able to help you all is incredible. So thank you all, and I look forward to the coming year with you all, and hopefully many more years to come. So today's class is going to be a little bit of a review for many of you that were in the class on Wednesday. It was Wednesday and Tuesday for the Inversores en Sectores, but I want to just go over a little bit of general information about order types. So talking a little bit about what different order types there are, when you may use certain types of orders, and then a little bit of information about what those actually look like in the real world. Because we can talk about everything on paper, but trading in the real world often is not like you think in real life. So we're going to talk about that all today. What order types exist, how we use them, and what they look like when put into actual practice. So without any further ado, let's see who we have with us today. Hello, Jorge, Chela, Emelida, Iris, Vero, Eddie, Claudia, Christopher, Kira, Juan, Veronica Schwartzberg, Andrew, WC, Berta, Francia, Ingrid, Gisela, Chela, Alex, Marianela, Magnolia, Juan, Fidelia, Lily, Susanna, Delia, Aladia. Wow, lots of new faces today. Jorge, Yesenia, Alma, and I think I got everyone. Hello everyone, welcome. Let's get to some fun. So today's presentation is going to be on order types. So we're just going to go really quickly through the basics. Orders is a fancy term for going out and saying, I want to buy or sell something. You don't just run outside into the street screaming, selling Tesla $410 a share. No, you place an order in the market. And the order is what you want to sell, how many shares of it you want to sell, and how you want to sell it. So different types of orders exist to allow investors to buy and sell exactly how they want. Where's the little goofball? Little goofball is right over there. She found a new little throne to hang out on. So different orders exist because investors don't just want to buy and sell at whatever the market says. They want to buy and sell when they want to. So that is why different types of orders exist. But when we look at price, we want to not just be able to see the price that the market says it's worth, but we want to see what we're actually trading at. So when you go to a website like Stock Charts, like Finance Yahoo, anything like that, the price that it says on the screen, it's not the average, it's nothing like that. It's literally the last time somebody traded that stock, what did they trade it at? So we're going to look at that today because that's not the price. If you put in a market order, which we'll talk about that in a second, but if you go and just say buy one share of Tesla, you're not going to buy it at $408.50, whatever the price may be. You're going to buy it at what the market is currently at. So let's talk about the different types of orders and when and how they can be used. So the main types of orders are as follows. And this is not a exhaustive list. This is not all of the different types of orders that exist, just the ones that we're going to cover today. So we have market order, which is the simplest form of a buy or sell order. We have buy limit and sell limits, so limit orders. We have stop orders, which are buy stop and stop loss or sell stop orders. We have our stop limit, our trailing stop, which is something many of you should be familiar with. If you're not, boy, do I have some fun information for you all today. And like I said, this is just the tip of the iceberg. There are lots of different orders that exist, not just one type of order, but you can use two different ones together in what are called conditional orders, which you can say, I want to buy if this, but also this, or if this, but not that. So let's start off with the basics. Let's start off with a market order. A market order is the simplest type of order that exists because it is not a, I want to sell at $410. For today, I'm going to be using Tesla as an example to briefly say Tesla's price today closed at $408.50. Let me just double check that. $408.50. So keep that in mind throughout the presentation. So when you place a market order, that is an order to either buy shares or sell shares at whatever the current market price is. And there's always a difference because there's this idea in the stock market of buy low, sell high. But that's someone else's job. That's not our job with a market order. Our job with a market order is to buy whatever we can buy. We don't care the price, we just want to buy it. Or I don't care the price, I just want to get rid of it. That's what market orders are. But because there is someone's job that it is to buy low and sell high, there's always a difference between the bid price, which is the buying price, and the ask price, which is the sell price. And just because you're placing a market order, which is your instant order, I want to buy it right now at whatever is being sold, that doesn't mean that you're going to buy at the price you see if you were to go to Finance Yahoo, for example. So you're not going to buy it at $408.50. You're going to buy it at whatever the cheapest offer that is being sold is. So that offer may be $450. You don't know that. You're just going to buy whatever the cheapest offer is. And that's the biggest thing about market orders, is they don't guarantee you a price. Just because Tesla says $408.50 doesn't mean if you place a market order, that's what you'll get. It only guarantees that whatever that order is will happen right away. So you say, I want to buy Tesla right now, fuakata on the button to go buy, and you instantly buy it. How much you buy it for is a different story. So let's again use this example of Tesla. We're going to say Tesla is $408.50. So using the current prices of when I made this presentation, the current bid for Tesla was at $408.79. So if you were to buy a share of Tesla at market price right now, you would buy it at $408.79. That is the current bid price. There may be 500 million people selling shares of Tesla, but the cheapest one on the market right now is $408.79. So that's the share that I would buy. Now, what if I were trying to sell and I were selling on a market order? Well, the current asking price or the current selling price for Tesla is $408.74. So 5 cents less. And that is what you would get if you were to sell Tesla. Now remember, we've talked about volatility a little bit. This is where volatility comes into effect because we have what's called the bid-ask margin. Or if you were to take the bid price and subtract it from the ask price, how much is there in the middle? In a very volatile market, you may see that the bid and ask for Tesla may be $430 and $390. That's a volatile market because there's such a big difference in what buyers are willing to buy for and what sellers are trying to sell for. But here we see that we're in a very stable market for Tesla. The buyers and sellers are asking just about the same price, and that 5 cents is someone's profit that they're making for actually being the one to buy and sell those shares. Now, I just mentioned there's somebody on the other end, because in order to have a sell, you need to have a buyer. And in order to have a buyer, you need to have a seller. Not the seller that's, downstairs in your house, a actual market seller. So who's on the other end of this trade? When I go to sell a share, who's actually buying that share? And the answer is, it depends. It depends on who you buy from or what exchange you're buying on. Because in the New York Stock Exchange, buyers and sellers are people. They're people like me or Juan de los Palotes or whoever. They are actual humans, an individual or an organization that is buying and selling shares, where sellers place their orders for what they are willing to sell for. Buyers then place orders for what they're willing to buy for. And the market matches the highest buy offer to the lowest sell offer. So again, using our example for Tesla, we had our buy of 408.79. Sorry, our sell at 408.79, and we had our buy at 408.74. So that means that there's no trades currently happening, but if someone put in an offer to buy at $409, for example, it will then sell to them the share that was the cheapest. So even though they bid over what the actual selling price was, they will end up buying at the lowest sell price. So that is how the New York Stock Exchange works. There's a bunch of people screaming, buy, 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 and a bunch of people screaming, sell, sell, sell. And once there's a buyer that is above the price that someone is selling, the market will then say, all right, you want to buy, you want to sell, stick them together, we have a trade. And they will buy at the price that that person is selling at. Now, this is the New York Stock Exchange. It is your typical, if you ever think of the stock market, you think of this. You think of people running around from different boxes, cubicles, whatever you have it, screaming different offers. That's the New York Stock Exchange. The NASDAQ is, in my opinion, a little bit more civilized. In the NASDAQ, you don't buy, Jonathan doesn't go and buy a share from Juan de los Palotes. Instead, I go and I buy shares, or I sell shares to what are called dealers. And this is what's called a dealer market. Hi, Josefina. Thanks so much for being here with us. So when you're buying from a dealer, these dealers set the buy and sell prices for shares. So they may sell 1,000 shares of Tesla at $408.75. So if I want to buy, instead of going out and screaming out of my balcony, buying Tesla, I would just go to the dealer and say, hey, I want to buy Tesla. And the dealer says, all right, I've got some Tesla and it's $408.75. Take it or leave it. There's no negotiation. There's no hoping that someone else comes and starts selling for lower. No. The dealer sells at their price, and you can either sell to the dealer or buy from the dealer. And they are the ones that set the prices. So now we've talked about the buyers and the sellers. Let's talk about the middleman. Let's talk about the person in the middle that actually makes all of these trades. Because again, if I want to sell Tesla, I don't run outside holding out my certificate of Tesla saying, someone buy this. My neighbors would look at me like I'm more crazy than I already am. What happens is if I want to buy or if I want to sell, I don't do it myself. I have my broker do it. So a stockbroker is somebody or a company that makes buying and selling equities easier. Because instead of me needing to go and haggle for prices and figure out all of that stuff, the broker does it for me. So I tell my broker, hey, TD Ameritrade, I want to sell my shares of Tesla. So TD Ameritrade does it. And they're the ones that will work for you, or with you rather, to get the best price. They will try and find the best buyer and the best seller for every trade. And there's many different options, but just to list some of the biggest ones, we have TD Ameritrade, Robinhood, Fidelity, Schwab, H&R Block. The list goes on and on. And where do they get their cut? The answer to that is not so simple, but let's take a simple answer. Commissions. When they make a trade for you, they take a little bit of money, or they charge you a little bit of money in order to make that trade happen. But because we are now in the online world, we all have Intel built into our brains at this point. Technology's made it easy for buyers, but also for brokers. Because now, the broker doesn't need to do as much work. They don't need a person to be able to do trades. They just need a computer. And computers are cheap and are very scalable. So because of that, the industry standard has changed. Most major brokerage companies used to charge about $6 to $10 per trade. Not per stock, per trade. So if I wanted to trade 1 share of Tesla or 1 million shares of Tesla, they would charge me $10, let's say. Now, because of technology, praise be technology, most major brokerage companies charge nothing for commission on online orders. So if I want to go buy and sell Tesla, they charge me nothing. But they do still make their money somewhere, where some brokerage companies will have commissions on mutual funds, ETFs, and options, and these prices will vary depending on the broker or brokerage company you look at. So if you're looking or comparing, do I want to go TD Ameritrade or Robinhood, for example, it's important to look at what you want to trade, because while stocks, I'm going to say basically every major brokerage company charges 0 for stocks now, so no commission. They will charge for mutual funds, or certain types of mutual funds, or ETFs, or margin accounts. So if you're interested, do your own research to figure out what the best broker is for the type of investments that you want to do. So now, let's go into market orders in a little bit more, well, not so much in a little bit more detail, but let's go over where they're good and where they're not, the pros and cons of them. So the pros are, it's instant. If you want to buy something, if I want to buy a share of Tesla, I get my share of Tesla right now. You press the button, fuakata, go buy it, you get it. And while we don't know the exact price that the shares will be bought and sold at, we know that it'll be pretty close to the bid or ask. Really quickly, I'm just going to pull up Finance Yahoo, but you can use any major website to see this. So here we see the last traded price. So the last time someone bought or sold Tesla, this is what it was bought and sold at. And here we have the bid and the ask prices. So the bid is, there's an offer in right now for 900 shares of Tesla at $407.90. There's also an ask for 800 shares of Tesla at $407.80. So if you're looking to buy or sell Tesla right now, and you bought it or sold it at market prices, this is the offer that you would buy or sell at. So you would buy at $408 or $407.80, or sorry, $407.90, and you would sell at $407.80. So the margin is now 10 cents instead of 5 that it was at this morning. So again, while we don't know the exact price, we can find it. And we know that whatever that price is will be pretty close to the bid or asking price. Now, what are the cons? Where are market orders not good? Well, if you're trading a volatile stock, you may buy a completely different price than what you think you're actually buying at. For example, earnings season happens. Companies have good earnings or they have bad earnings. And a single company's price can change 15, 20%, maybe even more in moments if the earnings report is good or bad, respectively. So I may put in a market order. I look at the market and I say, hey, look, Amazon just released all of their fundamentals today. They released their quarterly earnings, and it's incredible. Amazon's going to take off in price. I want to go buy it right now. That ship already sailed, honey. The price of that stock is already probably through the roof. And you, thinking that you're getting a good deal, say, I want to put in a market order. But you don't buy it what it currently says it's at. You buy it what the next person is selling at. So all of the other people selling, they know that it's worth a lot more. They know that the price is a lot higher, so that's what they're selling at. So you may end up getting stuck with paying a much higher price than you're looking to pay to buy, or you may end up selling way below what you wanted to actually sell at because that was the best offer in the market at the time. Adelita is asking, where do I find the best mutual funds? Morningstar has a lot of really good resources for finding mutual funds, looking at not just the asset classes, so the types of companies they invest in, but they rate them on a scale of 1 star to 5 star. And then above 5 star, they have what's called the blue chip mutual funds. So you can go take a look at Morningstar. There is a lot of stuff on Morningstar that you can't get for free, but it'll be enough to get started with mutual funds. Alex is asking, so buying and selling at market price, when do we know the true price buy or sell? After we've issued the order? Yes. You don't know what it is until you've placed the order and it completed. So often what will happen is buyers and sellers will put in a test offer. They'll buy 1 share to see what it trades at, and then they'll go and complete the entire order. Or they'll look at something like Finance Yahoo and see that there's an order for 900 shares at $470.90, and they'll go and fill that order. So really, you're looking at the bid and ask prices when you're trying to figure out what you would end up buying or selling for at market orders. So again, as I was just saying, placing a market order after the market closes is also a large risk because after hours trading is the thing. Just because the market closes doesn't mean that investors don't want to make some money. So they're going to be trading not on the stock market, but in their own brokerage companies or outside of their brokerage companies between friends even. So trades will happen and the market often will open at a different price than it closed at. So if, let's say right now, 4:25 p.m. Pacific time, I went and I placed an order for Tesla. It's not going to complete at $408.50. It's going to complete at whatever the opening price for Tesla is. So Tesla may open tomorrow at $320. Knock on wood, it doesn't. But it may. I wouldn't buy at $408. I would buy at whatever the opening price was. So market orders can be very dangerous if placed after hours because hours of trading and hours of price changes will go by before that order is actually completed. So what I thought I was buying at and what I end up buying at can be two completely different things. Now, before we go into the other types of orders, I first need to talk about one thing. Order duration, or how long do orders last? Because order duration is important. It says how long should it be left in the market? Because some orders make sense to just keep it in there forever. Other orders, I only want it to be in there a day, or I only want it to be in there a week, or another condition. So after an order is canceled, it can't be filled anymore. So that means that you're going to be waiting, and if the order never completes, okay, that's fine. No harm, no foul. Cancel it. So just to go through a couple of common order durations that you may see, the most common one is a GTC order, or good till cancel. In much easier terms, keep the order until I cancel it. That's all it is. It basically means, all right, put in an order for Tesla at $450. Just leave it there until I say otherwise. That's what GTC orders are. Then there is end of day, EOD. This is keep the order until 4 p.m. Eastern time when the market closes. Once the market closes, close my order too. I don't want it anymore. And then another one is immediate or cancel, which is essentially, I want to buy this right now, but I don't want to go at market price. We just talked about the risks of market orders. So I want to just say, okay, see if there's a buyer at $408.60. If there is, awesome. Complete the trade. If not, cancel it immediately. So this is a really good thing for you just fire a shot in the dark. You know if it hits something. If it doesn't hit anything, okay, no harm, no foul. We'll try again tomorrow. But I need to say this because this is very important, and this is where we talk about where I was talking before about how there's a difference between reality and paper trading. There's a difference between what will actually happen in the market and what we would like to think happens in the market. Where all of the order types that we'll talk about today, and we've talked about so far, assume a very low amount of shares are being traded, or the orders being placed are for 1, 2, maybe even 5, 10 shares of a company. But in reality, larger orders may be filled at different prices. So for example, a market order for 10,000 shares of Tesla, you may buy 50 shares at $400. Then you're going to buy another 5,000 shares at $410 and another 10,000 shares at, bye Lily, thank you so much for coming. And hello Rena, welcome. So the prices you buy at may change, and that depends on the availability. Where let's pull up our Tesla chart again. We see here that this bid offer is for 900 shares and this ask is for 800. What if I wanted to buy 1,000 shares? I'll buy these 900, but then I'm going to have to buy another 100 on top of that. So that may change significantly the price that you end up paying. By the way, the big bid-ask spread right now is at 0. Interesting. So, for the purpose of today, because I want to keep things simple, we're not going to talk about different order types that apply to larger orders, because it's not why we're here. I want to cover the basics and the fundamentals. We can go into the nitty-gritty stuff for the people investing $50,000, $100,000 another day. But some of these concepts that aren't going to be covered today, but if you're interested to learn more about, are fill or kill, FOK orders, all or nothing orders, and iceberg orders. All of these are ideas that apply to very large orders that are likely filling at different costs. So if you're looking to trade large volume and you want to learn more about this, here's some places to go start. But again, we're not going to cover those today. Those can be a topic for another day. Pablo is asking, who buys after hours? Just the hippos. So yes, the hippos are the ones that usually will be buying or selling after hours because they'll do what is called over-the-counter trading or OTC trading, where they will know who their seller is and they'll sell directly to that person or buy directly from that person. But a lot of brokerage companies offer people like you and me the ability to trade after hours. But it's not like market's still open, we're just running some back alley thing here. They only have certain stocks that can be bought and sold after hours. So if you're interested to do after hours trading, check with your broker what tickers or what companies they support after hours trading for, because it won't be all of them, it will just be some. So now we've talked about a couple of things. Reality is a crazy, terrifying world, at which point you're not going to always buy at a single price. We're only going to be talking today about buying one share, which makes things very easy, so we can talk about things on paper. So for our buying or selling one share, let's talk limit orders. Limit orders, unlike market orders, are not instantly filled. They will have an order duration on them, be it good till cancel, good till end of day, whatever it may be. And essentially what a limit order is it says the maximum price we're willing to buy at or the minimum price we're willing to sell at, where until the price reaches that certain point, the order won't be filled. It just stays in the market. So a buy limit order is like this. It is an order to purchase a security or an equity at or below a set price, where the current or the price for the limit must be below what the current bid price in the market is. Otherwise, it would just complete instantly. That defeats the purpose. So a sell limit is the exact same thing, but on the other side. A sell limit is an order to sell something at or above a set price, where the price that we are trying to sell at must be above the current ask price in the market. And it's worth noting here that this applies to only one exchange. For some companies that are listed on multiple exchanges, we can only have a limit order on one exchange, or rather the limit order only applies to the one exchange that we set it on. Again, for most investors, that won't really matter. You're only going to be trading in domestic markets, which makes it pretty easy. But some companies, for example, Baidu, is traded on the Chinese exchange, but does have foreign exchange certificates that can be bought and sold in the US. Okay, let's get out of theoretical world and let's talk some examples here. I want to set a buy limit order for Tesla at $400. So what does that actually mean? That means that I'm placing a buy order, so I want to buy Tesla, but we won't buy it until the price goes below $400. Hey, welcome back, Mom. So that is what a buy limit order is, where the price goes, when the price goes below $400, we would then buy a share of Tesla, not at $400, but at whatever that bid price is. So that may end up being less than $400. Say the price jumps down and it's $390. You would end up buying that share at $390. Okay, now sell limit order. We'll set our sell limit order for Tesla at $410, where we won't sell Tesla until the asking price or until there's a buyer that is willing to buy at above $410. So when the price goes above $410, we would then sell at that ask price. Not at $410 and 0 cents and 0 fractions of a cent. No, we would sell at whatever they're wanting to buy at, as long as it's over $410. So the benefits here is that, unlike the market order, we make sure that we don't pay more than we're willing to, because we've set the maximum that we can buy at or the minimum we're willing to sell at. So unlike market orders that can be riskier in more volatile markets where there's a larger spread between the bid and the ask prices, limit orders are fantastic in volatile and stable markets because you choose where you want to buy or sell at. It will not ever buy for more, and it will never sell for less than what you set it at. Now again, no type of order is perfect, otherwise I wouldn't even have to make this presentation. So because we are making buy orders on a stock and setting the max price that we want to pay, we may buy a sinking ship because we can set that order 3 months ago, and if we set it good till cancel, or we set no order duration on it, the stock's price may start tanking. It may start going down super quick. But hey, I wanted to just buy it. I didn't care what I bought it at as long as I didn't pay more than $300 or $400. That's great. Doesn't care what direction it's going. It just cares about the price. So you may end up buying a stock that's well on its way down, and you just got stuck with it on the way down. And the same thing is true for sells. You may end up selling a stock that is about to take off in price, and just because your minimum price that you were willing to sell at got reached, you've lost a lot of opportunity for profit in the process there. So that's something to keep in mind, is because you find the minimum you'll sell for or the highest you'll buy for, you may end up buying something that's going down, or you may end up selling something that's going up. So let's take all of this and flip it on its head. And let's talk stop orders. Stop orders are the opposite of limit orders, where we only buy or sell when a certain point is passed or a certain price is passed. But instead of it being the sell at the lowest or buy at the highest, it's the opposite, where a buy stop order is an order to purchase a security at or above the current market bid price, where the order only completes when the stock goes above that price that we've said. So it's basically saying the minimum I want to buy a share of Tesla at is $410. That doesn't make much sense, does it? Bear with me. I'll show you why it's great, or how these can be used in a moment. Sell stop orders are very rarely called that. They follow a better term called stop loss, where it is an order to sell a security, not purchase, sell a security at or below current ask price, where the order completes when the stock goes below that order price. Now, what does this look like in practice? Well, let's say that we place a buy stop order for Tesla at $410. The order will not complete, aka we will not buy Tesla, until the bid price goes above 410. When the price goes above 410, we would buy at that bid price, not at $410 and 0 cents and 0 fractions, but at the bid price, so that may be $412. Now, stop loss is something much more common that you may use. You say, I want to sell Tesla if it goes to $400. So the order will not complete, aka we will not sell Tesla until the ask price or the selling price goes below, the buying price goes below $400. Where when the price goes below 400, we would sell at that ask price. So why are these good? Well, in in the way of buy orders, it makes technical analysis trading, aka double top breakouts, much easier to do because you can go in and set stop orders above a resistance barrier. So you may look at a chart and you may say that the resistance barrier is at $408. So you can set a buy signal or a buy stop order at $409. So once we break past that resistance barrier, we go on a point and figure buy signal, and you didn't even need to lift a finger. You already bought that share. So it can let you buy a company right after something happens, aka a resistance barrier breakout, and gives you a great opportunity at buying right away. Just like it helps buyers, stop losses are great for helping to protect profits because they'll sell when the stock starts to go down to a certain point. Now you can either set a dollar amount or you can set a percent. And that's a trailing stop. And we'll talk about that later on in this presentation. Now, none of these methods is perfect. Why are these not good? Well, because an order is completed at the market price, you may end up buying well above what you'd be willing to actually pay. Again, we just talked about setting the minimum price you're willing to pay. I want to buy Tesla if it goes above $410. That's great, but what if Tesla had an earnings report and instead of going to $415 just went to $500? Guess what? You're not buying at $410. You're buying at $500. So you may end up paying well above what you wanted to actually pay. Or what if Elon Musk tweeted something really stupid and Tesla's price dropped $200 in 5 minutes? You're not selling at $400. You're selling at $200. Well, there went about half of my money. So because you only set the minimum of what you'll buy at or the maximum of what you'll sell at, you may end up buying well above what you wanted to buy at or selling way below what you wanted to sell at. But there's something in the middle. The best of both worlds. We've talked about why stop orders are great, and we've talked about limit orders and why they're great. So let's bring the best of both worlds together. Ta-da, we get stop limit orders. Before I go to this, Alex, I see your question. How often can we change the sell if the price of the stock keeps increasing? Is there a limit? There is not a limit. So most brokers only charge commission, if they charge commission at all, on completing an order. So as long as the order doesn't get filled, they don't charge you anything. And again, most major brokers don't charge anything for stocks as it is. So you can set as many stop orders as you want. You can set a stop order and a limit order. You can set a stop limit order, which we're about to talk about. Or you can set multiple good till end of days, where you just look at it in the morning and say, all right, today's buy offer is going to be at this price. Doesn't fill. Okay, that's fine. Go back tomorrow. Today is going to be at this price. It fills today. Awesome, I now own this company. Tomorrow I'll set my stop or my sell price at this. Didn't reach it. Okay, that's fine. Try again tomorrow. So there's no limit to There's no restrictions as to how many orders you can place. The only thing that ever matters is when those orders get filled. So, stop limit order. This is the best of both worlds, where it brings in the benefits of stop orders and limit orders. But now we need to set two things. We set the stop price, which is the price that we want to complete our trade at. That is our ideal price. And then we set our limit price. What is the most that we're willing to go? Now, by setting these two, we will complete the order if the price goes past the stop price, but not beyond the limit price. So now we've set a range. But instead of just giving you a bunch of words, let's give you some numbers and examples. This is something very clearly seen in examples. So a buy stop limit. Let's use this example. We want to buy Tesla if the price goes above $410, but not if it goes above $120. So we would set our stop price at $410 and our limit price at $420. So now we have our two numbers. Stop order at 410, limit order at 420. Where if the price goes above $410, we would complete the order. So say if the price went to $415, we would buy at $415. But what if it didn't go to 415? What if it went straight to 421? No deal. Because I told it I want to buy it when it goes above 410, but the most I'll pay is 420. I can't buy it for that. All right, order's canceled. Same thing for a sell stop limit. We want to buy Tesla if the price goes below $400 because we want to get a good deal. But if the price goes too far down, if the price goes below 390, let's say, I don't want to buy it anymore. That's a sign that it's a sinking ship. I don't want to be in on that. So we can do that. Where now, if the price goes to say $395, I would sell at $395. But if the price went down to $380, that's not happening. So it would cancel. And the last thing that I really want to cover with you all is trailing stop order, because this is what you should be using. It doesn't matter if you use market orders. It doesn't matter if you do. It doesn't matter what you do. You should set trailing stops, because trailing stops are just an insurance policy. It's the you go on vacation and you see it, set it, and forget it kind of trading. So you can use market orders to buy, you can use market orders to sell, but always make sure you have a trailing stop set as your insurance policy. Where trailing stop orders are a specific type of stop loss, where instead of setting a dollar amount, so instead of setting, say, a stop price of $400 for Tesla, where if it goes below $400 you would sell, we set a percentage, where the stop order will be filled when the equity's price falls below a certain percent below its highest price since the order was placed. Sonia saying that Fidelity charges a penny for 2 stocks when you sell. That you paid the other day, and I don't know exactly how they charge, if it's certain stocks or for everything. I would like to do some more research on that, because that is very interesting. I am pretty sure that Fidelity doesn't charge commission. They may charge you based on if you're buying or selling something. They may charge an expense ratio fee. So whether it be an entry fee or an exit fee. But that's definitely interesting. Let me do some digging into that, and I'll have a better answer for you on Tuesday. So let's go through an example of setting a trailing stop order, because this is, again, the most, if you take away one thing from today's presentation, take away trailing stops. Here's an example. I will set a 10% trailing stop on Tesla. So if the price of Tesla is $410, and I have a 10% stop order price, that means that if the price goes 10% below 410, then it will automatically sell. So what that means is our stop loss is 10% of 410, or $369. So if Tesla goes below $369, automatically I will sell Tesla. Now, what if the price goes up? Because remember before, our stop losses were set at a dollar amount. So we would have said, set our stop loss at $369. Now, what if Tesla goes up to $420? What if it goes up to $600? You don't want to sell at $369 anymore. No. You want your sell price to move with your current price. So if you make your profit, you get to keep some of that profit. So our trailing stop will change with the price of that stock. So if the price goes up to, say, $420, our stop loss price now changes as well, where it's 10% of our new highest price. So $420, 10% of that is $42. So our new sell price, our new automatic sell price, or our stop loss price, is at $378. So we see that the price that we want to sell at went up by $9. So now we sell and we keep some of that profit. Bless you. So that is what I wanted to cover today. Again, if you take nothing else from this presentation, take away the importance of trailing stops and what they mean. Because I've given the very simple example here of $410 to $420, but let's use an extreme example. I want to set a 10% trailing stop on Tesla, and Tesla in 3 months from now is at $600. Awesome! I made $190 a share. I made a ton of profit. I don't want to sell at $369 anymore. That's ridiculous. So the trailing stop will change with the price. So the price will go up to $600, and because we set our 10% trailing stop, 10% of 600 is 60. So our sell trailing stop, or our sell price with this trailing stop, would be at $540. So again, a trailing stop will change the sell price based on the price of the company. If the price goes up, the trailing stop will move up as well, so that if you make your profit, you get to keep some of that profit. Victor is asking, what if Tesla after hours falls like 20% and opens with 20% below the day before? Then you remember that a trailing stop order is still a stop order. You don't sell at 400, or you don't sell, for example, at $369. You'll sell at whatever the best asking price is below $369. So that may be, if Tesla really had a bad day, that may be $200. And that's what you'll end up selling at. Because you need to have a seller if you're buying, and you need to have a buyer if you're selling. So if there's no buyer for your shares, you're going to have to just sell at whatever the best buy offer is. So again, that's the risk that comes with stop losses, is that you don't sell at your 10% below line. Once your sell line hits, it just becomes a market order. So you just end up selling at whatever the market is going for at that time. And yes, wonky. So you would end up selling at whatever it ends up being. So you would end up, so for example, if it happened after hours, you wouldn't sell after hours. You would have to manually go in and sell if you wanted to sell after hours. Your order will only fill first thing in the morning. The market opens at 9:30 Eastern time. Boom. That is now the new price. If that price is well below your trailing stop, then you will now put in a sell order at market price. You don't get to choose. It just does it automatically. Are there any other questions about anything we've talked about? So again, we've talked about market orders. It is the idea of buy and sell instantly. I don't care what the price is, I just want to buy it. You will end up buying and selling at the current bid and ask prices in the market. You can set your limit orders, which will say the highest price you're willing to buy at or the lowest price you're willing to sell at. And it will fill the best order from there. Or you can set your stop order, which is the minimum price you'll buy at and the highest price you'll sell at. These are really good for if you want to buy when a resistance barrier is passed, or you want to sell if the market is starting to go down. Consuelo, so you can set a trailing stop with whatever time limit you want. You can set it good till cancel. If you want to see it, set it, forget it. But if you want to have, say you think the market is going to be really crazy this week because, I don't know, let's use last week as an example. The election happens, you don't know what the market's going to do, so you want to put in a much more conservative sell offer. So you may put in a 5% trailing stop for a week. So it's good until the end of the week. So Friday comes around, you didn't sell, great. That order is now canceled. Or you buy your shares of Tesla, you put them on the wall, and you want to forget about it. I don't want to think about my investments. I just want to know that if the market starts to go down, that I'll sell off. Trailing stop is great for that because it's good till cancel. It will be there until I choose that I don't want to have it there anymore. And because it's a trailing stop, it will move the actual sell price will go up as the stock goes up. So again, here we see if the price was $410, our trailing stop would be $369. If the price goes up to $420, now the stop loss is at $378. Josefina, yes, your broker is likely going to require that you own the stock before you can put the trailing stop on it. You said that I have first trade when I put a trailing stop at 11 p.m. The next day it disappeared. Make sure that the order duration is good till cancel, not end of day or EOD. So make sure that it is on your, the trailing stop is set for the duration as good till cancel. If there are no other questions, then I think that that is all I have for today. Thank you all so much for joining us as usual. I hope that everyone has learned something today. If you have any questions, feel free to send an email to support@sectorsmadesimple.com and we can answer your questions there. And until next Tuesday for our members class, thank you all so much. And I hope that this information has helped make investing and choosing your buy and sell prices that much simpler. Kike is asking, when you buy stock and it goes up 10% and goes down to whatever you set the trailing stop at and then goes down in the same day. So the trailing stop is from the highest price that the stock reaches. So the stock may go up to $600. Now your trailing stop is 10% below the highest price. So it would be $540. All right. Thank you all so much. We will see you all next week. Have a great weekend, everyone.